In finance, we tend to look at financial statements, the income statement, the balance sheet, the cash flow statement, etc., with the reason of doing comparisons. What are we comparing? In this case, I've gone to Morningstar.com, and we're looking at Dell, the computer company, and here we have their income statement. Now, if you look at it, there's just a bunch of numbers. It would be hard to compare Dell with itself. It would be impossible to compare Dell with another company. Why? Because the companies may be of quite different sizes. So how can we create or modify this income statement so that we can do some comparisons? Well, what we do is we create a common size income statement. We can also do that with the balance sheet as well. This allows us to do comparison with the firm with itself over different time periods. That's what we'll do in this little tutorial. But you can also compare companies with other companies or with the industry average because you've standardized them or created a common size statement. So if you're not familiar with the financial information that Morningstar has for companies, I have a separate tutorial for this, but you can actually download this income statement by hitting export, and it will download it to an Excel spreadsheet. I've already done that for both the income statement and the balance sheet. And so you can look here, I've downloaded the information. I did delete that one column, which was the last column, which was year-to-date stuff. So we just have these 5 years of data. And again, this would be a company that has $6 billion in revenues. Now, what do you do with that? How do you compare that with a company that only has $500 million in revenues? You can create a common size income statement. And the standard way we create the common size income statement is we create it as a percentage of revenue, or sometimes, depending on the income statement you're looking at, sometimes they call it sales or net sales. We're going to divide everything in 2008 by revenue. And then in 2009, we're going to divide everything by that year's revenue. And so that's what I've done over here on the right-hand side of my spreadsheet. I've taken revenue, which is in cell B3, and I've divided it by what's in cell B3, but I put a dollar sign in here so when I copy it down, it will continue to use revenue. So you can see here, the top number here changed to B4, but it's still dividing by B3. So we can see the cost of revenue in 2008 is 80.91%. We can see that gross profit is 19.09%, etc. We do the same thing for 2009. In fact, if you just copy it over, when you go, because I did not put a dollar sign in front of the letter, it will now become C, which is perfect. So what we can see here is that in 2009, the cost of revenue, sometimes called cost of goods sold, again, depends on the balance sheet, or I'm sorry, the income statement that the firm prepares. Okay, same thing. Went up to 82.07%. In 2010, it went up to 82.49. In 2011, 81.47, and then in 2012 it went down to 77.75. So what we can do is we can make a comparison. We can see what's happening over time. Okay, cost of revenue went up, and then it went down. Okay, which meant gross profit went down, and then now it's gone back up again. So by looking at these percentages rather than these absolute numbers, we could also compare Dell to a computer company that was 10 times larger or 10 times smaller, because everything would be in percentage terms. So cost of revenue for a very small computer company would still be comparable to this. It might be 75%, might be 84%, but we could do comparisons. Similarly, we can do it for the balance sheet. Okay, where we did comparisons of, or we standardized in terms of revenue or sales for the income statement. What we're going to do for a balance sheet is we're going to standardize in terms of total assets. So we're going to take all of these numbers and let's just look at 2008. We're going to take these numbers and we're going to divide it by total assets. And that's going to tell us, for example, what percentage cash and cash equivalents make up of total assets, what percentage short-term investments make up of total assets, etc., etc. So that's what I've done over here on the right-hand side. And again, you can see that I've divided B6. B6 is where where cash and cash equivalents are, and total assets is down in B23. And again, same thing, I put a dollar sign so when I copy down, it keeps this locked, it doesn't change it. So we keep dividing by what's in B23, but I did not put it in front of the letter so that when I copy across columns, it will change. So what can we see here? Again, we can now make a comparison. If we were over here at the original balance sheet, it's kind of hard to know what's going on here. Yeah, the number is going up, but is the company getting bigger? Is it getting smaller? What's exactly happening here? So what we can see is that the cash and cash equivalents went from 28.17% to 31.52% to 31.60%, so hardly changed. And it jumped up a bit in 2011 to 36, then back down to 31.11. So it's easier to do the comparison over time to see how things are changing. All right, let's see, we could look at gross property, plant, and equipment, and we can see that it went up and then it went down. Now it's going down. So it's easier to do this comparison. Again, we could look at a company that was 50 times bigger or 50 times smaller, and the percentages would be the same. So we could see what percentage of total assets does the company hold in inventories, and we can see whether Dell is comparable to other companies, is holding less inventories, is holding more inventories. So common size financial statements are an excellent way to begin your comparison of financial statement analysis, to compare across time for your own company, but also to compare how your company is doing compared to other companies in the industry or the industry average.